day, and welcome to Environment 360 Wraps. I am Viv Govender. This week we're going to start off talking about the Eurozone. We haven't looked at it in a while. I think that's an interesting, part of the world, at least as big as the Chinese and the American economies, and we just don't spend enough time looking at it. Then we're going to look at the possibility of having a inflation target change in South Africa, lowering it to maybe 3%. What impact that might have on your investment decisions. And finally, in our AI/tech segment, we look at a new report from Mary Meeker. For those that don't know, Mary Meeker is a legendary analyst. She started off, in the last, basically the 20th century, in the 1990s, and the internet boom took off. And her yearly report, which continued until I think 2019, was often considered to be one of the have-to reads or must-reads in the tech sector. And she hasn't done a report for 5 years or so, when she came out with something just the last couple of days, which is very interesting. It's 340 pages, but it's not that hard to read if you want to get into it. But I'll give you a little summary of what I saw there and what I think you might want to look at going forward. So let's start off with the Eurozone. So the ECB cut interest rates, again, further widening the gap between European interest rates and the US. They are able to do this because, they view, of course, the Eurozone has more stability at the moment. Growth isn't very high in the Eurozone, unfortunately. Roughly in the last decade, the Eurozone has grown by about 10% in total, which is very, very low. Compare that to the US, which has done more than double that. Now, what you must understand is that the European Union as a whole is very large. More people than the US has. An economy overall the same size, as the US and China roughly. But since about 2008, we've seen a big divergence in terms of growth rates between the European Union, Eurozone area, and the US. The US basically recovered after 2008, continued on its previous trajectory higher. The European Union has not. It has really, really stagnated over the last almost 20 years now. We're talking 18 years from 2008 till now, to the 17 years basically. That's a long period of time, for areas large as the Eurozone to basically have almost no growth. At the time of the Great Financial Crisis, the European Union and the US, many parts of the European Union, had similar, income levels to the US. Right now, the wealthiest parts of Europe, like places like Germany, etc., would be among the poorest states in the US. Nowhere near places like California or New York City state, but places like Mississippi, Alabama, which are considered to be very poor parts of the US. That's the richest parts of the European Union. Why has this occurred? There's many examples of this, many reasons. The European Union has really not been able to take off in terms of the tech sector, like the US has over the last couple of decades. You can't name a single large European internet company, for instance. I mean, the biggest one you might think of is Spotify from Sweden. But where's the European Google? Where's the European Microsoft? Where's the European Apple? Where's the European Amazon, Facebook, Netflix? You can name a bunch of different major tech companies in the US that don't exist in any form in the European Union, or nothing comparable exists in any form in the European Union. There's multiple trillion-dollar tech companies that started in the last 30 years or so. There's none in the European Union. Even if you cut the number down to $500 billion, nothing in the European Union in that period of time. So the European Union has really, really had a bit of a setback over the last, like I said, almost 2 decades. The fact of the matter is that lowering interest rates in the European Union is unlikely to do much about this. The issues the European Union has around regulation, which is what's holding them back from the AI space, for instance, around coordination between the various large economies, France, Germany, etc. They are cooperative, but they are not a single economy. They're not one country with one budget that can basically coordinate properly. And I think also the lack of representation in the European Parliament European Parliament is one of those weird structures which has a lot of power, but the actual ability of people to vote for their representative there is very limited. All those factors come together and give us a region that is punching well below its weight in terms of growth. Areas of Europe that have done reasonably well recently are places like Ireland. I mean, the recent Irish GDP number of 10%. Okay, first you understand that 10% number in the first quarter of 2025 is due to a couple of things. Firstly, the Irish economy is overblown because of the fact that they have lower tax rates, and that means a lot of companies like Apple, etc., have pumped profits through Ireland to get the lower tax rate, and also because of Trump's tariffs, we've seen many companies basically pump money into what do you call this? Pump exports, rather, into the US before the tariffs come into play, and which means that exports are part of GDP, and the more exports you have, the bigger your GDP number looks. So that combination made that GDP number look very strong in Ireland. But ignoring that, even it's done reasonably well. There was a period of time, several decades ago, where Irish people were considered to be, low-income workers that came into the the UK. But they've really done really well in the European Union and have really pumped themselves up. We've seen that also happen in places like Poland. Poland has, caught up effectively to Japan in terms of per capita GDP. This is a remarkable movement, and we've seen many places in like the East who have done really, really well upon joining the European Union. But the problem is that the core of the European Union, places like, for instance, France, Italy, Germany, the three big European countries, they have not really done well in the last little while. They had a period of boom, several decades ago, but over the last decade and a half, 2 decades, they have not really done much, and they are facing major issues. I mean, Germany with electricity, energy, from which has been disrupted because of the war with Russia. Towards the whole of Europe because of the demographic situation, where they have a declining, birth rate, well below replacement, which means declining workforce, etc. But even ignoring that, this region, the core of Europe, has really, really underperformed and shows very little sign of recovery. And in fact, in many ways, the danger around Europe is going to increase going forward. I, for one, think that if you've been trying to buy a car recently, you would see that the Chinese cars are not just up there; they are value for money, way better than anything else on offer, especially from Europe. And quite frankly, if you look at just how big the car industry in places like Germany and France are, it's a huge source of demand of GDP. You also look at what has been helping the German economy, for instance, over the last couple of decades, which is selling high-end manufacturing goods to China. The Chinese are taking up that slack. And in some places where they're not taking up the slack, a place like ASML, which is the chip machine maker, the Chinese have been forced to basically start doing their own local production. I think the next couple of decades for the European Union are going to be really tough. They're going to have the issue of declining birth rates, which means a declining working age population. They have the most generous welfare in the world, which means that they pay out the most amount of money for things like old age pensions, as well as for healthcare, which is free healthcare in all of Europe. When you don't have a large enough working age population, that becomes very, very difficult to handle. When your working age population is declining, while your old age population is increasing, and you basically have this huge amount of money that you pay in pensions and so on, that is not sustainable. At the same time, they have not been able to ratchet on or to cling on to the next technological revolution, which is AI. They kind of missed towards the internet almost entirely, with the exception of things like I told about Spotify, etc. But like Google, Facebook, Facebook, they seem to be totally missing out on the next level of technology, which is AI right now. So they miss out on the internet, they're missing out on AI, and they have a real need to grow in order to basically pay for this massive amount of liabilities they have around their welfare state. So that's the European Union. And at the same time, like they're cutting interest rates right now, which I think makes sense with their growth rate being as low as it is. I do think that it allows them to get away with having this huge budget deficits that they are having at the moment by having interest rates being a bit lower. But as Japan has shown, this is not a sustainable path, and eventually you've got to do something about growing your economy. If not, what awaits Japan, what Japan is going through right now, the European Union is going to go through over the next couple of decades. Now, moving on to South Africa's inflation targeting. There has been a move by the Reserve Bank to bring our inflation target down to about 3%. The benefit of this is huge. You get the inflation target down to 3% and you keep it there. That means interest rates that people demand for the South African government to lend them money goes down. And I've seen estimates saying in excess of 800 billion rands in savings is available if the South African government can get, or the South African Reserve Bank can get the inflation target down by 1.5%. Now, that's a huge amount of money. 8.5 trillion, 800 like something billion rands. That's a huge saving for the government. But the danger for this is that if you get your inflation target down to 3% and there is a supply shock, oil, another COVID disruption, whatever it may be, and suddenly inflation starts moving higher, what are you forced to do? If your inflation targeting at 3% and inflation is now at 4%, you've got to bring inflation down to 3%. And how do you do that? Higher interest rates. If you don't have an economy that's naturally has an inflation of about 3%, that is, inflation is probably going to be at 4.5%, and you try and make it 3%, you are going to destroy that economy because you're going to have interest rates way higher than it should be, and that's going to basically cause economic growth to come under a massive amount of pressure. So, for the Reserve Bank to be pushing this strategy forward, I think is ambitious, but does come with risks. Now, is it the right time to do this? Well, if you look at inflation right now in South Africa, it's below that target of 3%. But like I said, we are a very vulnerable country. We saw just a few years ago, inflation went well above that. If there was, for instance, a war in the Middle East between Iran and Israel, for instance, oil prices would spike, inflation would spike up as well. If there was another increasing, conflict between the US and China, if there was some disruption in global trade for whatever reason, inflation could easily spike up again. And is the Reserve Bank going to be willing to start raising interest rates high enough to fight that inflation, to bring it back down to 3%, when the economy in the country is not growing that fast, when it probably would cause a recession? That is the main dilemma here. Apparently, according to the finance minister, she's looking at the proposals, but I think that there's opportunity here, but it must be done very carefully. Now, moving on to this AI report we talked about. Mary Meeker, like I said, very well-known analyst, hasn't done a report in like 5 years. 340 pages is a huge amount of stuff to look through, and I've read through it, and so I just want to give you my key takeaways from here. Firstly, AI is being adopted faster than any other technology in history, far faster than the internet, far faster than personal computers, far faster than the car, electricity, anything else we've ever seen in the past. Next, this is the first technology that is not limited geographically. So the cars first came to the US and then came to other parts of the world, like Europe and so on, or like US and Europe are the two main parts, but you weren't finding cars in, for instance, the Congo as quickly as you're finding them in Western Europe and the US. Electricity also took a while to get in the world. Telephones a while to get in the world. The internet a while to get in the world. I mean, broadband came to South Africa later than other parts of the world. The AI technology we're seeing right now is being adopted internationally faster than anywhere, any technology in history. Why? Because the infrastructure laid down for the internet makes the AI technology instantly available to anyone that has the broadband technology that the internet required. So if you have streaming services in your country, you have the ability to instantly get access to the latest model from GPT, latest GPT model from OpenAI, or from DeepSeek from China, or Gemini from Google. They're instantly available. People in India are among the biggest users of AI, bigger than, in fact, the US at the moment. So geographically, the spread has been instantaneous. There's not been that same small, diffusion around the world. In fact, there used to be a saying that the future is here, but it's not evenly distributed. This time around, it's being evenly distributed, far faster than it was in the past. Next, we are starting to see huge cost savings in terms of per token costs. The progress over the last decade in terms of cost per token, according to this report, was in excess of 100,000 times. So what would have cost you $100,000 10 years ago cost you less than $1 right now. A huge saving. And it seems to be continuing the speed. This is faster than Moore's law. This is faster than the laws we've seen in the past with, for instance, broadband costs. Broadband costs do not fall 100,000 times in 10 years. So that's another thing we are seeing. Faster adoption, far faster progress in terms of costs. The next thing is we are seeing not, even though there's a huge amount of adoption happening and a huge amount of spending happening in terms of consumers, the infrastructure ramp up is even in excess of the revenue ramp up we are seeing. So the costs for producing these models is going up, and running these models is going up higher or faster overall, because yes, the cost per token is going down, but the amount of usage is just going parabolic. So the amount of money that's costing to run these systems is going up even faster than the revenue that these systems are generating. So even though the revenue generation is faster than anything we've ever seen in history, OpenAI basically got to 800 million users in no time. But even with this kind of scenario, we are still not seeing revenue keep up with the costs that are coming along with it. And historically, when we've had these kind of, how can I say, these revolutions, generally you don't find the incumbent in the sector being the one that wins the thing. So IBM was the incumbent in computers, but they did not win the PC race. It was Microsoft and other players out there. Microsoft was the incumbent in the computer sector, but did not win the mobile race. Apple did it. We saw, there were probably horse traders around there. They did not win the car race when transport got revolutionized. However, this time around, maybe it's because the last revolution, the internet revolution, is so near to the current revolution, the AI revolution. We have seen that the biggest incumbents are the ones that are willing to spend the most money. Meta, Microsoft, Google have all spent tens of billions of dollars, on AI. They've restructured their entire, R&D spend. They've, in some things like Google, restructured their companies in order to basically take advantage of AI. So we have a case where huge amount of spending required, even though revenue is going up, and you have the incumbents really playing a very proactive role in trying to basically develop the technology, which leads you to believe that it's likely, at least right now, that the biggest players are going to be the ones that survive this AI race. If you had to bet on who's going to be the biggest AI company out there in a few years' time, yes, OpenAI done really well, but I'm not sure if they are going to be able to match the spend that Google is willing to put into play to progress AI, or Meta is going to be willing to put into play to progress AI. These companies don't just have the benefit of having huge distributions, like for instance Meta's, billions of people that are on Facebook and Instagram and WhatsApp, etc., or the billion plus people that are using Google's products like YouTube and Google's search engine and Gmail and that kind of stuff. They also have effectively money-making machines. Both Google, Facebook, Microsoft, these companies all have huge money-generating machines that are able to go and finance this loss-making AI, rollout more than I think a company like Anthropic or OpenAI is going to be able to match up with. Because Anthropic and OpenAI, they can't rely on these other parts of the business that generate a huge amount of money to fuel their growth. They are going to rely on investors putting more money in while they're still making losses. So that is the key takeaways here. Fast progress, but at the moment, it looks like the big players are likely to be the biggest winners in this particular sector at the moment. Okay, thanks for joining me. I look forward to seeing you guys in next week. Cheers.